On paper, many corporate projects look exactly right. The returns clear internal hurdles. The spreadsheets show healthy margins. The assumptions are reasonable. The logic is sound. And yet, across corporate America, boards are increasingly responding to these proposals with a frustratingly simple answer: not yet. This hesitation is not about incompetence or lack of opportunity. Boards are saying not yet to projects that look profitable because the definition of risk has changed, and profitability alone is no longer enough to justify commitment. For most of the last few decades, board approval revolved around expected return. If a project met the required return on investment, aligned with strategy, and fit within budget, it moved forward. Risk was acknowledged, but largely treated as a variable that could be managed. Today, boards are approaching decisions differently. They are asking not just whether a project can make money, but whether the company can live with the consequences if it doesn't perform exactly as planned. The first reason for this shift is uncertainty that doesn't resolve on a predictable timeline. In earlier cycles, delays or shortfalls could be modeled as temporary. If demand arrived late or costs ran high, companies assumed conditions would normalize. Today's environment offers no such reassurance. Interest rates, labor costs, regulation, geopolitics, and consumer behavior are all moving independently. When uncertainty becomes persistent, boards grow cautious about locking companies into multi-year commitments, even profitable-looking ones. Another major factor is the rising cost of being wrong. A single underperforming investment can trigger analyst downgrades, activist pressure, and leadership scrutiny. Boards are acutely aware that downside outcomes now carry reputational and financial damage that extends well beyond the project itself. The penalty for a mistake often outweighs the reward for success. Forecast confidence has also eroded. Projects depend on assumptions about demand growth, pricing power, and execution timelines. While these assumptions may look reasonable, boards increasingly question their durability. Forecasts that once felt solid now feel fragile. When confidence in projections declines, profitability on paper becomes less persuasive. Boards would rather wait than commit based on numbers they may not trust 6 months from now. Irreversibility plays a central role in these decisions. Many profitable projects involve fixed costs that are difficult to unwind: long-term leases, facilities, specialized equipment, or permanent headcount. Boards are now highly sensitive to how hard it would be to pause, scale back, or exit a project. If the answer is not easily, hesitation increases, regardless of projected returns. Labor dynamics amplify this concern. Hiring is no longer a flexible lever. Wage inflation, benefits, compliance, and retention costs make workforce expansion a long-term obligation. Projects that require significant hiring raise questions beyond profitability. Boards ask whether the organization can support that workforce through a downturn without painful layoffs or morale damage. If the answer is unclear, approval is often delayed. Financing conditions also matter. Higher interest rates and tighter credit have changed how boards view leverage and liquidity. Even profitable projects can strain cash flow during ramp-up phases. Boards are prioritizing balance sheet resilience and liquidity buffers over incremental returns. A project that absorbs cash today for profits tomorrow may be postponed in favor of preserving financial flexibility. There is also a sequencing issue. Many boards are not rejecting projects outright, they are delaying them. The concern is not whether a project works in isolation, but whether it works right now. Timing has become strategic. Boards prefer to wait for clearer signals on demand, cost stability, or policy before committing. Not yet often means the idea is sound, but the moment is wrong. Reputational risk further shapes these decisions. Failed projects attract attention. Analysts question judgment. Employees question leadership. Successful restraint rarely draws criticism. Boards operate within this asymmetry. Saying yes carries visible downside. Saying no or not yet carries little immediate cost. This naturally skews decisions toward caution. Governance dynamics reinforce this behavior. Boards are charged with protecting the long-term health of the organization, not maximizing short-term returns. In volatile environments, protection often takes precedence over expansion. Projects that look profitable but introduce fragility face higher scrutiny than those that enhance resilience. Importantly, this does not mean boards have become anti-growth. Growth is still essential, but it must now meet additional criteria. It must be flexible. It must be staged. It must allow for course correction. Projects designed as all-or-nothing bets struggle to gain approval. Those structured with milestones, optionality, and exit paths stand a better chance. This is why many companies are redesigning how they propose investments. Instead of large upfront commitments, they present phased rollouts. Instead of aggressive timelines, they build in checkpoints. Instead of single forecasts, they show downside survival scenarios. Profitability opens the door, but resilience secures approval. The broader implication is significant. Corporate America is shifting from return-first decision-making. Boards are less concerned with how much money a project can make in the best case, and more concerned with how much damage it could cause in the worst case. Boards are saying not yet to projects that look profitable because profit no longer guarantees safety. In an environment where volatility persists and mistakes linger, caution has become rational. Waiting is not hesitation for its own sake. It is a deliberate choice to preserve flexibility, protect credibility, and ensure that when companies do invest, they do so on terms they can endure, even if conditions turn against them.